Hello, everyone. I am live. I am trying this again. I I recorded on Friday. However, I made lots of mistakes. I was distracted. Had lots of background noise, which I may have today as well. Um, Unfortunately, uh, the condo building that I live in is doing construction outside, and I am unfortunately at their mercy when it comes to that. It sucks, and I'm a little nervous that that could mean that people don't listen to me, don't follow me, don't subscribe to me. But it's one of those things. It is what it is. When you live in Florida and you get a condo or a penthouse that is has a fantastic, amazing view. Well, unfortunately, the downside to that is that the buildings with the best views, the buildings with the best views in Florida, and people that are sheep from up north that are trying to find uh, new places to live away from the communists in California and in New York. They're learning this as well. The best places with the best views throughout South Florida, not just Miami, but all throughout South Florida, whether it be Fort Lauderdale, Pompano, Delray, Boynton Beach, Palm Beach, wherever, to get those best views of various places on the intercoastal as well as the ocean and so forth. The those buildings with the best views are the buildings that were here first and that were built in this condo boom that happened in the late 60s and early 70s. And there's not many condos from the late 60s and early 70s that were built during that time frame. But throughout South Florida, and that's everywhere throughout South Florida, those condos, or shall I say these condos, because I'm in one of them, are the best views. And they're still in very good shape, but there is a downside to that, and the fact that there's constantly non-stop renovation with these condos. Uh, and it's just one of those things. It is what it is. So they're doing some construction on my building, fixing some stuff outside, but I am going to press forward. I am streaming today a little sooner than I usually have in the past. I usually stream about 3 o'clock and stream until and record until 4 o'clock when the closing bell happens, because I got stuff to do after 4 o'clock, so I can't record past then. But today I am recording earlier in the day. It's just after 1 o'clock, so hopefully this is better. I can have more time to talk about more stuff, and hopefully the sound technology will do a good job of buffering out the background noise. So I apologize in advance for the background noise, and I'm just gonna do the best that I can do. And on Friday, I tried to record, but my brother's girlfriend was here, and she was in the kitchen cooking. And I got to tell you something. I've lived with many roommates throughout my life, and seen many individuals and relationships and stuff. This girl has so much control over my brother. It is insane. And what's fascinating about it is that he thinks that he's in control of the relationship, but she is in complete control of the relationship. His free will is 125% an illusion. And he is clueless. He thinks that he has control and can dictate what and how the relationship goes. But I have never seen a guy be in such a situation where he has no idea or no input whatsoever as to how the relationship is going to go and who is in control. You know, I think she's really cool. I think she's great. They're going to end up probably getting married at some point. But just from an outside looking in, his free will is completely and utterly an illusion. And I have never seen a guy in my entire life totally oblivious to what's going on in a relationship. And it'll be interesting to see how this plays out. But she was over here on Friday, and I was distracted. I made lots of mistakes on the stream last week, and I apologize. I'm sorry. I'm still trying to get a handle on all this, but I am not in any way, shape, or form a bona fide content creator. I don't know what else to say. I have the opinion that a majority of these content creators, specifically when it comes to the financial markets, are not trading real money, because to do this perfectly, to do this really well, you know, have a nice background, have a nice lighting, have nice charts, have everything set up perfectly well to have a great production. I think you have to put 120% into that and not focus on the markets. Okay? If you're gonna do this super well, and then make like tailor-made videos for each platform, because the way that you make a video for TikTok is different than the way you make a video for YouTube, and the way that you would make a video for Substack may be a little different than YouTube. And to do everything very well, and to have everything with high quality production to get more and more views from people, specifically in the finance world. Okay. I don't see how you can run a portfolio, do research, go through charts, listen to other people's podcasts, do research, go through each individual company's fundamentals, look at charts, do all the stuff that you need to do to run a trading business. I don't know how you can do that and have high quality production without background noise, noise, without life getting in the way, whether it's people coming over to your house or construction outside or the lighting's not right or I don't know, there's tons of stuff that happens. You have to only do content creation and focus everything on content creation and not have any focus on actual management of your portfolio and watching the market. And specifically, a lot of times, a big part of a trader's job is to actually do nothing specifically and just watch the market. Because when you sit there and you watch the market, you can allow the market to talk to you. The tape action will show you what's going on and what's happening and how everything's going about. And it may not tell you what the market's going to do, but it tells you what's going on. And a lot of work is actually just doing nothing particularly, just watching the tape action. And that's a big part of trading. And as you can see, just zooming in here and taking a look at all these symbols and watching them move and watching relationships of these symbols, the relationships of how they move with other stocks and other indices. That is all very important when it comes to trading. So with all that said, I am going to start talking about what's going on in the market. And the one interesting dynamic that's taking place in the market right now is dispersion. Now, dispersion is something that is not discussed a lot in many areas of the market, but it is something that is very, very, very important right now in this market, because when you look at the S&P 500, you can see that we're getting very, very big moves, moves that we're not used to seeing historically. And I have talked about in the past how I think that the fact that we have 0 DTE options, days to expiration options, that are now actively traded is having a large impact to how you've got such a drastic, vicious move to the upside. And subsequently, after last week, it adds to the downside move as well. Now, if we go to the trade tab and take a look at the S&P 500, I actually want to pull up the SPX, the mother of all products, the S&P 500 index. And I want to take a look at the implied volatilities on these options for the S&P 500. And if we take a look at these options that are going to expire in the next day, 2 days, 3 days, 4 days, 7 days, 8 days, 9 days, you can see here how the implied volatilities for these options are right around 17 to 19%. Okay, which makes sense because when we look at the SPX, and then we look at the VIX for the S&P 500. We take a look at the implied volatility for the S&P 500. Where is it? There it is. We see that, we take a look at the VIX for the S&P 500 here, and we see that it is right at around 18, close to 19. And we go out to the options on the SPX that are out about 30 days, we see that it's at 18. Okay, because the VIX is looking at the prices of options going out 30 days. If we go out to 30 days, we see that the VIX is at 18, right? Where the implied volatility on the options going out 30 days is right at about 18%. Right where the VIX index is at 18.8%. Very, very close. And the actual VIX index is a blended average of multiple expirations, multiple strike prices for the SPX options. And we take a look at the implied volatility for the next day, 2 days, 3 days, 4 days, for the next week or so on the SPX. And we have an implied volatility of about 20%. A little bit further out, 7 days, 8 days, 9 days, we have an implied volatility that's close to where we are 30 days out, which is at 17, 18, 19%. Now, as you can see, as I'm speaking in the middle of the day, right after 1 p.m., you can see that these things are moving, okay? As the market moves, these implied volatilities moves because these options are trading and these implied volatilities are moving. So what's interesting is that, you know, if someone asked you, hey, what's the implied volatility for the SPX? You tell them it's about 18, 19, 20%. It's about 18, 19, 20, give or take. If you want to go down the rabbit hole, you could say, well, how far out in expiration do you want the implied volatility? And they'll look at you like you're crazy. Because if you find these types of stuff fascinating and you want to learn more about this stuff with the market, trust me, there's going to be a certain number of people out there that are going to think you're crazy. They are going to think you're crazy. It's just how it is, unfortunately. Yeah, so it is what it is. But the implied volatilities for the market is about 17, 18, 19%. The reason why this is important is the general market as a whole, the indices, have this implied volatility of about 18, 19, 20%, depending on how far out in time you look. But if we look at other individual stocks, okay, let's start out with NVIDIA, and we'll look at other stocks after that. You're not going to see 18, 19, 20% implied volatility. You're going to see other implied volatilities. Let's start with NVIDIA. Okay? Ooh, big difference, okay? These options are a lot more expensive on a volatility basis, okay? We have 49%, 46%, 42%, 46%, 44%, 45%. Go out further in time, past 74, 100 days, 120 days to expiration, we're looking at 46%, 48%, 49% implied volatility. So from an implied volatility basis, just looking at the extrinsic value, the time value of these options, an individual stock like NVIDIA these options are much more expensive than the implied volatility of the options on the S&P 500. Okay. Now, the S&P 500 is a $7,400 index. What we can do is to give a better comparison to help you understand how much more expensive these options are on an individual stock like NVIDIA. Or I'll look at another stock like Apple or Meta, or who knows, just to get the concept through, help you better understand that. Let's take a look at the SPY, okay? And we'll look at the SPY here, and we see that the SPY is 1/10 the size of the SPX, and the implied volatility of the SPY is the same as the SPX. But we take a look at these options. Let's just take a look at the options that expire in 2 days, or maybe 10 days. We'll take a look at 10 days just to get this point across. You can see, we go take a look at the at-the-money options, and you can see the 740 strike, which is the at-the-money calls and puts. Here we have the puts, here we have the calls, here we have the at-the-money strike for the SPY. They're trading for about $8 to $9 for one contract. Now, I showed you the implied volatilities and how much higher they were in an individual stock like NVIDIA. Okay. But let's have some fun here. Let's take a look at the SMH. Now, the SMH is another index-related product, but its implied volatility is much higher than the SPY, I think. I'm correct. So you see here, it's 64%. Now, the underlying is a little cheaper than the SPY. The SPY is trading at $740, okay, a share. The SMH is about $140 cheaper on a dollar basis, okay. But the implied volatility is 64%. It's a lot more juiciness in the options. And let's take a look at the same expiration, 10 days out, okay? And the stock is just $140 cheaper on a per share basis, okay? And theoretically, if the price per share is $140 less expensive, the options should be, if the implied volatility was the same, should be less expensive. But no, with a 64% implied volatility, these options are more than twice expensive, almost 3 times as expensive. So instead of being $8 to $9 a share, a contract for those at-the-money options, these options are $21 to $22, almost $22 a contract. So that right there, the fact that these options in the SMH are so much more expensive on a per contract basis and on a volatility basis. That shows that these semiconductor stocks, these individual semiconductor stocks, and we looked at NVIDIA, but we're going to look at more stocks as well. Their implied volatilities are very, very, very high. They're very, very juicy. And that is the dispersion in the marketplace, that professional traders are selling options in the major indices like the SPY or the SPX or the Qs, and are buying individual stocks like NVIDIA. like, Micron, like Western Digital, like AMD, and so forth. And that dynamic is adding to the moves that we're seeing in these stocks. And if we take a look at another chip stock like AMD, you see here 76% implied volatility. Very, very, very expensive options. Okay, just like NVIDIA. Okay, we'll take another look at NVIDIA. We'll see here. We'll see that these are 46, 45% implied volatility options. And we look at the we go back and take a look at the AMD. We have 75 to 80% implied volatility options. Very, very expensive options. Okay, we'll go on. Let's take a look at a few other stocks. Let's look at Micron. Okay, this is showing this dispersion, how these individual stocks have huge implied volatilities and huge expected moves, but the indices themselves are very, very low. And what's happening is these trading firms are selling the options in the indices, and they're buying the options in these individual stocks. You see Micron, 109% implied volatility. We go out 10 days, we have 112% implied volatility. We go out a little further out in time, we go to 74 days to expiration, we have 103% implied volatility. Huge, huge, huge expected moves. And you see here in the parentheses, you see these expected moves for that time frame. 39 days out. Look at this. 39 days is not that far out in time. It's just for the into July. $286 expected move, 110% implied volatility. That's huge, huge, huge moves. And you can see here how just going through these various stocks that you have to be careful for these individual stocks because they're going to have huge moves going forward. Okay, don't be alarmed by that. And that brings me to my next key point in all this. Okay, with many, many momentum strategies and methodologies, they like to use specific percent stop loss rules. And in a market like this, specifically if you're managing trading individual stocks, that will hurt you. Okay? Because if you have a set stop loss for 7 to 8%, that works for the general market. Okay? Okay? Because we go back to the SPY. Okay? We go back to the SPY. And we see that, the implied volatility is 19%. It's a 19 VIX. You have an expected move for the next 10 days of $19. You go out further out in time, it's an expected move of $36 on the SPY. And it's a $740 product, a $741 underlying. We'll take a look at the chart here on the SPY. Okay. And I'm going to pull up the Bollinger Band chart here. Okay. Let me make sure this is the right. Yeah. So this is a Bollinger Band chart on the SPY. If you're looking to use a 7 to 8% stop loss or a 10% stop loss on a underlying that you want to buy, and the general rules for many momentum methodologies are when you get to a 7 to 8 to maybe sometimes 10% loss, you cut your losses and you move on. If you're using an underlying that has a lower implied volatility, like the indices right here, that's fine. okay? Because you're not going to get a move that is massive, that will blow out your stop and then have the underlying just reverse and go higher. When you're looking at the S&P 500 and you have a VIX that is at 1819, and you're looking at the options and you have these options that are at 17, 18, 19%, what that is telling you is that for the next year, the market is expecting the S&P 500 to move up or down by about 18 to 19% over the next year. So having a stop loss of 8, 9 to 10% is not unreasonable. Okay, you may get stopped out. The markets may sell off by 7, 8, 9%, but it's not an unreasonable target, because the market could sell off that amount, and it may take 2 months, 3 months, 6 months to happen, and it is what it is. But when you look at an individual stock, okay, like Nvidia or Micron, let's go back to Micron. Let's go back to the options page, the trade tab for Micron. When you look at these implied volatilities of about 100%, what the market is telling you is that its expected move over the next year in a stock like Micron is north of 100%, up or down. Now, theoretically, a stock can't go down by more than 100%, but it's saying that Micron could double from here to the upside and may even go further than 100% to the upside. With that being said, and the type of moves that you get on a daily basis, and today is a perfect example. We take a look at Micron here. It's at close to $950 a share, and it's up by $85 a share. It's trading higher by almost 10% on the day. So if you follow methodologies that have a set percent stop loss on a day like today, and your stop loss is less than 10%, you get stopped out on a day like today very, very quickly. Micron moved over, I think it was at least 10%. I think it moved at least 10% down on Friday. It may have been over 15 or possibly close to 20% on the day. It was a big, big move. And throughout the day, depending on the time of the day, it was down 15 to 20% of the day. I mean, it was huge. You would have been stopped out within a day on a stock like Micron on Friday. And guess what? It's bouncing back today. So you get like whipsawed out of it, and it's very, very frustrating. And when I first started trading, I used to always be pissed off because I would have this set percent stop loss on an individual stock. I would get stopped out, and then the next day or day after that, the stock would rebound and go higher. I'm like, it's like the market wants to it's like watching my stop loss. It wants to kick me off and then keep going higher, and it drove me crazy. What pissed me off was, first, I would always get whipsawed out, but second, it was like the market is watching for me to get whipsawed out, and I don't know exactly why. It's like it zoomed in on me. It's like, I'm gonna stop you out, and then I'm gonna rip higher, and it just drove me crazy because I couldn't understand the dynamic of what was taking place. And as time went on, I learned options, I learned volatility, and I learned expected move, and I realized, oh, okay, there's a stock, it has an expected move, it has an implied volatility. My stop loss is inside of what a reasonable expected move is for the stock within a certain period of time, it stops being out and then, goes back and reverts to the mean inside of its expected move. So, with all that said, with all this dispersion going on, okay, with the trading firms selling premium in these index products, and what they're doing is they are going and they're looking at these options that expire within the next couple days. We had the 0 DTE options that expire today, but you also have options that expire in a day, 2 days, 3 days, 4 days, right? And they're trading at that 19% implied volatility. So they'll go out, and if you take a look at these SPY options, we have the volume and open interest. And you can see here in the SPY, look at all these options that are being traded. And we're going to take a look at the Qs. We're going to take a look at the SPY, the SPX options as well. And you can see how these are options that are being sold. And they're selling these at the monies and out of the money puts, and then selling these at the monies and out of the money calls. And they're doing it with 2 days. They're going out to 3 days. And they're also doing it with 0 DTE. We'll look at those as well. You see how look at all this volume here. These out of the money and at the money calls that are being traded, and most of these are being sold. And these are sold at the money and out of the money calls. They're doing both calls and puts. So basically selling straddles and selling strangles. And they're doing this in the SPY with 3 days, 1 day, 2 days. Let's take a look at the options that expire today. Look at these volumes of at the money options, okay, and then out of the money options, okay. And we'll take a look at the calls. These are at the money options, very close to at the money. A little bit of the options that are a little bit in the money, but very close to at the money. And then all these out of the money options being traded. And we'll take a look at the SPX. And the volumes are just insane there as well. It's crazy. But I want to get this all across to you guys so you understand what's going on in the marketplace, that you have these professional traders selling these options in the options that expire with 0, 1, 2, 3, 4 days to expiration, commonly known as the 0 DTE options. And as you can see here, look at these SPX options that expire today. Look at all these options, thousands, one after another after another. And basically, it's the options that are close to at the money, slightly in the money, and then all these options that are out of the money. And same thing, at the money options and out of the money options. And they're selling these options, primarily selling these options. And what these strategies do is they take that premium that they get when they sell these options, and then they'll go into a stock like Micron, and they will go to the weeklies. These options expire in 4 days in Micron, and then after that they expire in 10 days, and they will go and they will buy these at the money and out of the money options. And what they're basically looking for is the indices as a whole to not move too much, okay, to basically move within their expected move. Okay, if you get a market that moves inside of their expected move, that's good for these trading strategies and these trading firms. And so they'll go and they'll buy these options, puts and calls, in a stock like Micron that has 4 days to expiration. And they'll do this over and over and over and over, and they're doing it day after day after day after day after day. It's what's going on. And I have contacts. I don't know if I would call them friends because they're internet friends, They're people that I've met in person a few times, but it's not like we're, like close friends, but we stay in contact, we talk, but I would never be invited to their wedding. But if you want to call them friends, you can call them friends. But they are contacts, and I am hearing this from our traders in the business, and this is going on. It's been going on, and I think it's going to continue to go on. So the reason why all this is important to the individual investor is that if you're looking to use a percentage stop loss for a stock like Micron or Nvidia, you have to make sure that you look at the expected move as a guide to where you should use your stop. So for a stock like Micron, if you look at the options, and we can take a look at the charts too, we can see the Bollinger Bands, and you see that in 18 days the implied move is $204. We go out a little bit further out in time, we got 30 days or 32 days, that's almost a month, it's $255. If you have a stop loss that is only $50 or $70 or $100, you look at the options implied move for a stock like Micron, that is not even close to enough cushion. You're probably going to get stopped out because the probabilities that if you have a stop loss of $100 from where the stock is now, I think it's probably like a 70 or 80% probability that price would be touched before a month or so. So make sure that you go to the trade tab, look at the options. If you don't have Thinkorswim and you can't look at these numbers, what you can always do is determine how long you want to hold this stock for. And 30 days is a good benchmark to use for a trade, a short-term trade. Do I want to hold the stock for at least 30 days? And go to the at the money options and look at the straddle. That's the back of the envelope way to do it. When professional traders were on the floor and they didn't have all these fancy tools back in the olden days, that's what they looked at. They just looked at the straddle. And you take these options, so that's about $115 plus $115, $120, you get about $256, give or take. So that is the expected move. And that is a reasonable expectation of where you should put the stop for a stock like Micron if you're going to hold the stock for about 2, 3, 4 weeks. So with all that said, let's take a look at the chart. I'm going to pull up these Bollinger Bands that I took a look at earlier, and as you can see, we're at $953 a share. You have the 20-day moving average of about 860, which is about $110 to the south, less than where the stock is now. The lower Bollinger Band is right about 612, so that's a good cushion. I would use, you have that gap here below the 20-day, right at around 770. That would be a point where you could put a stop loss in. It's about $200. That's a more reasonable expectation of where to put a stop in. And that's a little different than using the hard nose methodology of a certain percentage stop loss. And I think in the olden days, when these methodologies just use that fixed percentage. The market was much more different than it is now. Now when you have all these, with all the electronics and all the technology, and now the way you have these weeklies and zero DTE options, and then all this different types of electronic trading, and all these firms doing all these different types of dispersion and risk parity type of trading strategies like I just described. You didn't get big moves that were super fast and super efficient like we have today. Yes, you got big moves, and everybody talks about the market that we're in now is like 1999, 2000, 1999, 2000. If I had $1 for every time I heard someone on YouTube say 1999, I would be a gazillionaire, because it's just non-stop, over and over and over. 1999, 2000. I'm like, shut up. Just go back to your bedroom and listen to Prince. I don't want to hear it anymore. There's some people on YouTube that have been saying it's like 1999 literally for like 7 years. And it's like, for the love of God, would you just shut up? Do you have any other analog that is different than 1999 and 2000? Yeah, it seems like you have like this fantasy where you just want to live in 1999 and 2000 over and over and over in a continuous loop. Anyways, that's just what we hear, and I've discussed how I think that this AI build out, this AI boom, this AI move is different than the .com era move. Not to say that we couldn't have a bubble in the future. I just do not think we have a bubble right now. And the main difference, the main dynamic for why we don't have a bubble is that when we built out the internet in the 90s, we didn't have applications. We didn't have specific things that we were going to use the internet for. It took many, many years after 2000 for us as a society to figure that out. And we eventually did. It's not like that right now. There are people that are saying, okay, I want to do this, I want to do that, I want to build this, I want to build that. I need more compute. I need more GPUs, TPUs, RAM, storage, fiber, etc., etc., etc. And that dynamic is what I think is the main underlying reason why we're not in a bubble right now. Now, here's the thing, okay? And not many bulls will say this, but I'm going to say this. When I say we're not in a bubble, I say we're not in a bubble right now. Could we go into a bubble in the future? Absolutely. And I think Gavin Baker, who is a hedge fund, a portfolio manager, and a protege of Peter Lynch, said this very well. If you are naive enough to think that, okay, we're not in a bubble, we're never going to be in a bubble, we're not going into a bubble, that's very, very, very naive thinking. And I think he has a fantastic point to that. Something could happen that we can't predict. Things change, we go into a bubble, market crashes. But we're not in that point right now. Okay? We're not at that point right now. And, I think that, and I've said all this before, but I just want to emphasize this again. When I listen to the bears, their argument is basically pretty simple. Basically, it's that stock prices just keep going up and up and up and up and up, and fundamental valuations are too high. The problem is that's not necessarily true. And as I'm speaking about this whole bubble dynamic, and we're looking at the Micron chart here, let's pull up some websites. By the way, it's about 1:53. I've been yapping for about 53 minutes and I haven't even looked at like charts of individual stocks. I do love this early start because I can't do this every day, but one day a week at least I can just dedicate the afternoon to just yapping and talking and yapping and talking. Because I don't have many friends because I spend so much time in front of the screens watching these blinking lights all day long. This is kind of therapeutic to me to talk to myself and look into the camera. So I like this early start. So going forward, I'm gonna try to do the early start. Plus, people are not like me. They have normal lives. They have normal jobs. They have normal friends. They contribute to society. They make the world a better place. This this time during the day while people are working or eating or whatever, living their life, I think this works better. So anyways, let's pull up Micron on FinViz. Now, this is a fantastic website for fundamental data. You can get it for free, but it has a bunch of ads and stuff. But if you want it for free, that's fine. You'll have to deal with all the ads and stuff on the side. But it's very good for free, and you basically get all the features for free, except for like specific like scanning features or whatever. But it's a good site, and it has decent charts, and it has all these fundamentals. But if you're looking for a charting platform, you could pay it's $40 for all this stuff. It's a write-off for me. That's why I pay for stuff like this. But decent charts, and what I love about FinViz is it has all this fundamental stuff. So back to what I was saying earlier before I went off the beaten path, talking about how I should continue to do these rants in the middle of the day. I think it works out better for people. Take a look at Micron. Yes, the stock has had a huge move, right? We can see it here on the FinViz chart, right? But let's scroll down. Look at these fundamentals, okay? This is the main thing. Now, Peter Lynch talked about this when he first left Fidelity, and he always used to go on Wall Street Week with Louis Rukeyser. He goes, the main thing you have to look at, the main thing is the PEG ratio. Everything boils down to the PEG ratio. That's price divided by earnings divided by growth. Okay, everything boils down to the PEG ratio. So even though a stock like Micron has just been running like a banshee, just below $1,000 a share, and the stock was below 200. It was actually below 50 a couple years ago. Whew. You look at the earnings. Look at this for the annual earnings. Huge move in sales and in earnings per share. Go to the quarterly numbers. Look at this growth. That's huge in sales and in earnings. And we look at the PEG ratio. Price divided by earnings divided by growth. It's 0.07. Anything below 1 is good. Okay? But you have 0.07 in a stock like Micron. That is fantastic. That is not overvalued. Okay? You want to hold on to a stock like that like grim death. Okay? It's got low debt to equity ratio. Look at the growth on these earnings. 5-year earnings growth is 130%. This is fantastic. Okay? Now let's go on to another stock like NVIDIA. Okay? Name that everybody watches so closely. Okay? It's got a 0.37 PEG. You've got a growth rate for the next 5 years of 45%. It's trading at 16, almost 17 times earnings. This is not expensive, okay? Let's take a look at AMD. It's another one that people follow very closely, okay? 0.59. It's undervalued. It's trading at 37 times earnings, and you have a growth rate of 77% next year and 62%, almost 63% for next 5 years. Okay? And the key is this. It doesn't necessarily matter what your forward PE multiple is. It's what your forward PE multiple is in relationship to your growth rate. As long as your growth rate is above your forward PE multiple, okay? As long as that price to earnings multiple is below what your growth rates are, you're good to go, okay? That's the key. And that goes back to basic stuff that Peter Lynch talks about from the 90s. Another guy like Bill O'Neill, who founded Investors Business Daily, says the PEs don't matter. I believe personally he's right, but there's also an element that is not quite 100% told. If you're just looking at the PE ratio in autonomy by itself, it doesn't matter. What's key is to make sure that if the PE is too high and it's above the growth rate, if the PE is super, super high and it's above the growth rate, then the PE is too high, okay? But as long as the PE is high, you know, it could be like 50, 100, 150. As long as the growth rates are higher than the PE ratio, you're good to go. But if we look at these individual companies here, and I'm just going to look at a couple others. Let's take a look at Western Digital, okay? And we're just going to look at the PE ratios, the multiples, and the growth rates, okay? This year, 102%. Next year, 75%. The year after, next 5 years, almost 75%. You're looking at a 29.8 multiple. That's very, very low. And the other thing is we always look at the forward PE ratio, okay? Because the forward PE ratio looks at the multiple for the years out in the future. The trailing PE looks at the multiple years behind. We don't care. The market doesn't care about what's happened. It cares about what's happening in the future. So you look at the forward PE, okay? Specifically, you look at the forward, next year's earnings, next 5 years' earnings, okay? 0.4 peg. That's really low, okay? That's fantastic. In anything, you want to peg below 1. That's the key. Now, let's take a look at a few other stocks. How about Taiwan Semiconductor? Okay, that's the key. That's the key. Chips tech stock. They make all the fabs for all the semiconductors, right? So 0.68. Okay, 21, almost 22 multiple, 25% growth rate, 32% growth rate for the next 5 years. Look at the sales growth rate for annual sales growth rate. Fantastic. EPS, fantastic. And there's still people there that think it's a sell. Eventually, they're going to have to upgrade this to a buy, and that is going to push the stock even higher. I actually like it when there's people, analysts that are bearish on a stock like Taiwan Semiconductor, because they haven't done their homework, and they eventually have to upgrade to a buy, and I don't think they have. Yeah, they haven't done that yet. Okay, so let's take a look at another stock. Let's look at Bloom Energy. Stock it's not a chip stock, but it's in the AI complex. And I also want to look at Astera Labs and maybe Callistic, a couple others. See, I didn't plan this. I didn't plan this at all. I just start, going through the peg ratios and the growth rates and the multiples of all these names is something that like I wanted to do anyway. So why don't we do it on air, right? 0.5 peg, fantastic. 0.5 peg, forward multiple of 58. Now by itself, compared to the other stocks, 58 may seem high, right? But take a look at the growth rate, 104%, 114% out in 5 years. I love that. When you have the 5-year growth rate higher than the 1-year growth rate, that means you're getting accelerating earnings. And you can see it here in, this stock is still not profitable. It's still, in the negative here. But the sales, look at that. You go from in 2020, 79 cents a share all the way up to 245. It is running. Now, what I do not like is that they're issuing shares. That is a negative. So that's not good, and that may hinder the stock going forward. But look at this stock. Quarter-over-quarter earnings growth rate, 313%. That's fantastic. I mean, there's just a lot of stuff going on that's really great about this stock, and it's had a huge run, and right now it's going back and forth. It kind of, have consolidating, trading in a base, and I think, is, it still hasn't broken key, support levels. I think you could buy it here. Especially if you have a long-term outlook. Just don't get shaken out if the stock drops to 200. Okay, a lot of methodologies say, oh, the stock drops that much, it drops to 200 from 250. You got to sell because it's dropped a certain percentage. Well, with all that said, let's take a look at Bloom Energy's expected move here. $68. You go out 32 days. It's pretty reasonable to say you're going to hold on to the stock for a good month or so, right? It could easily drop by $68. So with all that put together, you can use options, you can use charts, you can use fundamentals, and look at it all as a mosaic, and say, hey, $68 expected move. This stock drops to 200, fills this gap, goes down to this, here, this shelf here. That's perfectly reasonable. It may go down to 174. I would still be bullish on it. Now, let's take a look at Callistica. Okay, I've talked about this before. And take a look at Callistica. Stock has had a nice move up and a big reversal down. It's holding its moving averages. We'll take a look at the thicker swim chart here for Callistica. You can see that big, move outside of the upper Bollinger Band, and a big reversal down to the 20-day moving average. You see how the slow line is moving up, trending up, and the fast line and rate of change have come back down lower. They're back into the negative territory. I think Callistica could easily bounce around here, but it could also go down to the lower Bollinger Band. It could really, honestly, it could either do either way. It's kind of like in the middle of its range here, right around the 20-day. It could either come down here or go back up here and test this swing high up here, just above this upper Bollinger Band. But from a fundamental point of view, like I said, it's got a 0.56 peg, 25 multiple, but it's got a 47% growth rate for next year and a 45% growth rate for the next 5 years. This year, its growth rate's over 69%. So I don't see anything that's wrong with this. They make a lot of cable and fiber for data centers. It's a Canadian company. They have a lot of hyperscalers as customers. I love them. And you can see it's in the middle of that range. And you also see on the relative strength index. It's right at 50, so it can really go either way in the short term. But in the long term, I think you got to hold on to the stock and be very bullish. Year-over-year growth rate's 131%. That's fantastic. And everything looks good. And another one of these stocks, these AI stocks that has a low peg. That's why I don't, and I've showed you multiple stocks now. There's lots of stocks that are not overvalued. We don't have pegs that are over 2 or 3. A stock that's overvalued, if you want to make the argument for an overvalued stock, it's Apple. Look at this. Okay? It's a 2.5 peg. They don't have their own large language model. If there's a stock that's open to be disrupted, it's Apple. Okay? And as I speak, the stock is getting sold off right now. It's down $3 on the day. They came out with some news about AI and so forth. I guess the market doesn't like it, but it's selling off today. Apple unveils Apple Intelligence AI features with privacy focus at developer conference. So that's the latest news on Apple. And let's take a look at the intraday chart for Apple. I'm looking at it on another screen here. And we take a look at the intraday chart on Apple. It's just it's getting sold off here. Look at the 5-day 2-minute chart. The stock was above 317 before it came out with the news that you just saw in FinViz. Now the stock's at 305. It's completely reversed and selling off. So that's what's happening right now as we speak. Apple's trying to bounce here a little bit, but nothing. It seems like nothing. They didn't come out with anything that's game changing or anything like that, because the stock is down on the day. It's down by $1 on the day, and it's bouncing back a little bit. It traded down to close to under 304 share. It bouncing up about here at 306, but it is a stock that's bloated, and you can make an argument that it's overvalued with that high PEG ratio. I've owned the stock for so long. That's why I own it, because I do own the stock, and it's kind of just like it's become like a utility stock in a way, and I sell covered calls on it to generate premium. But I've owned it for so long, because in the late 2000s, and specifically in the early teens, like 2010, 2011, 2012, that stock was my big winner. Okay? Huge. It was my big winner. I think it was my first real big winning stock, because I made money on it on options, and my dad made money on the shares. Okay, I made money on the options. Okay, and what happened was, it was my first big winner, because I was in college and I was studying psychology and doing my thesis and stuff, and chasing female college specimens around as best I could, because I was no like James Bond or anything like that, but and I was distracted. By school and women. I know I have a good number of women that tune into my my videos, but I was in college. I was dating and trying to be the swashbuckling man that I am, and I was busy with school too, studying behavioral finance and all that stuff, and doing various school activities and stuff. And I was, up until about 2010, I was day trading nonstop. And once I got kind of busy with school, I let my positions run. And that first position that I let run and with options was Apple, and the stock just ran, and I doubled and tripled my money in a very short period of time, and that's when I really realized, oh, if you get a big position and you hold on to it, and it works out in your favor, regardless of what you're doing in your life, whether you're in front of the screens all day or you're busy at a job or you're at school or whatever, you can make a really crap load of money. And I remember, I love this story because I was really losing and not doing well, and I went to a seminar with the Nigerians, and I met John and Pete Nigerian, and I got to talk to John. I said, John, I don't, what am I going to do? I bought these calls, they're losing money. You know, I know Apple is going to go up eventually, but I can't, I don't want to close out these calls and then lose all my money. He goes, turn it into a call spread. Hold on to the calls that you have, roll them out, buy some time, and turn it into a call spread. So roll out the calls that you have to a further expiration and sell calls against it, and just keep doing that, and it will offset your costs for the option. And I did that, and the stock, ran, and I doubled and tripled my calls. And then I realized, okay, I think I got this. And then I also realized, okay, you got to find a system, a methodology, and you got to learn options better. I realized I didn't know enough about options, and so then I studied options. I read various books on options and volatility, and I started watching Tasty Trade. That really helped me. Tasty. Now it's called Tasty Live, but there's some downside to Tasty Live. I think you can get in trouble selling options premium. Specifically just selling options premium. I've seen a lot of people do very, very well as just selling options premium, and you wake up one day and the people are gone. They disappear. You don't know what happened to them, and usually it's after a big market move, and they blow out because they're basically collecting pennies in front of a steamroller. And when something happens in the world that's not expected, and they lose a ton of money very quickly, and then they're gone. The best way to make money, I think, in the market is to follow the Peter Lynch, Bill O'Neill type of method, and just pick good stocks and hold. Let these businesses, the stocks that you buy, let them grow and earnings accumulate and make money. And if you want to get fancy and trade options, there's nothing wrong with that. But just realize you're getting fancy. You make money by owning good companies that have fantastic quality businesses that make money nonstop. And that's how you make money. Trust me. Another thing I wanted to talk about today is Market Wizards books comes out. Market Wizards is a series of books. This is going to be the 6th book for Market Wizards. Let's pull up. This is going to be the 6th Market Wizards book. It's written by Jack Schwager. And there's not a lot of books that I recommend, but Market Wizards books are some of my favorite. And I already ordered the book. It comes out next week. Sorry, it comes out tomorrow. I already ordered it. It comes out. It's released tomorrow. It's $32. You can get it on Amazon. A couple guys that are going to be in the book is Lance Brightstein. He's pretty popular. I think he's got a YouTube page, and he's got a website and all. So he'll be in the book. I think maybe Chris Camillo will also be in the book, but he was in the other Market Wizards book, so I don't know if he's going to be in this one or he just, maybe featured or talked about. I don't know. But I love these Market Wizards books, and I wanted to discuss this and say that reading these books really helped me become a better trader and a better investor. They really, really did help me. So I highly recommend them. And also, if you haven't read the Market Wizards books, get the latest one and then read the others too. You'll learn a lot. They're fantastic, and they're on audiobook. You can listen to them on audiobook. So if you're busy and you can't sit down and read a book, there's nothing wrong, in my opinion, with listening to a book as well. So with all that said, got Apple here selling off, on this news that I guess the market doesn't like its latest AI announcement. So let's take a look at, I wanted to go through, and I'm glad that I started at 1 o'clock, because if I started at like 3 o'clock, I would have to have ended the stream by now. I would not, but since it's, I could still keep talking. I wanted to go through some individual charts of some stocks. So let's start out with Apple, since they just came out with that news. They just came out with that news on whatever with the AI. And like I said, I think that Apple is way behind in the AI race. And that may work out for them in the future, because they're not spending so much money on CapEx, but they're just, way behind. When you talk into Siri and ask Siri questions, what you're doing is you're just basically using Gemini or ChatGPT. Siri really isn't like a large language model. It's just, they're just using, Apple's just, licensing out your question to ChatGPT and Gemini. So Apple is selling off here. I think that, everything looks fine from a fundamental point of view. It's still holding the 20-day moving average. But, the slow line is coming down on Apple, and the slow line on the weekly chart is trending up. So it makes sense for this slow line to come down and go into the negative. And once it gets into the negative, the stock may continue to trend lower towards the lower Bollinger Band, and then at that point you'll have the rate of change well in the negative, you'll have the slow line in the negative, you'll have the fast line way oversold towards, say, -8 or -9, and it will make more sense to buy the stock right here around 292 to 295 after it's sold off from this point. With all that said, it can still bounce off this 20-day, go back up to new highs. May be more unlikely to do that with with the way the news is out today. Because as I'm speaking, we can go back and take a look at the intraday chart on Apple, and you can see how it's not picking up any steam. I thought it was bouncing a little bit at 304, but it's not. It's not picking up any steam. It may easily take out 304, and it took out the lows from the overnight trading session, and it seems like it's starting to pick up some steam to the downside because there is no green bars on this chart right here. That means that there's no buyers stepping in here. It just stopped going down for a little bit. And since they're not getting any green bars here, it makes more sense for the stock to make another leg down before the day ends. But back to the chart with Apple, I think, it sells off right to the 20-day moving average, and we'll see if this holds, but it makes more sense for me to see the stock go down towards the lower Bollinger Band and get the slow line into the negative before you look to buy for a long-term chart. Let's see, another stock I wanted to look at was Eli Lilly. Eli Lilly, I'm very bullish on for the peptide trade, the GLPs and the new peptides. And also, they are doing lots of things in cancer research. So, Eli Lilly looks very interesting to me. The stock is trying to break out to the upside. It traded above these key levels here, right around the 1130 level, and the stock has not gotten much follow through to the upside. So it broke out to the upside above these previous highs, but it's not getting much follow through to the upside. And I would like Eli Lilly to continue to get some follow through to the upside. It is above the upper Bollinger Band, but you can see how the fast line is not above the previous highs on the 310 oscillator. What is good is that when you look at the weekly chart, you can see that the slow line is now going back into the positive, and so that shows that the stock can continue to move higher. The slow line is trading higher, but now it's flattening out. So what we may see with Eli Lilly is the slow line kind of come down towards zero, especially now that you're seeing a divergence in the fast line, and the stock may kind of form some type of bull flag type of pattern, consolidation, bull flag type of pattern, as this slow line kind of comes down towards zero, and then you get a move up higher in Eli Lilly. And as that happens, the 20-day kind of will inch up higher, and the stock may pull back towards 1100 as the 20-day moves up towards 1100, and then it does this back and fill type of action and then breaks out towards the upside. And as that happens, you'll get a move down in the fast line, and then it can then have a thrust back up towards the upside. So Eli Lilly still is looking very good for the long term, but for the short term, the stock is not getting any up follow through, and it is due for some back and fill type of action, some consolidation before it makes a move up, makes another move up higher. Another stock that I wanted to talk about is NVIDIA. And NVIDIA has had some kind of concerning tape action recently, because the main level that I was looking at was right at this 211 level on NVIDIA, and that level goes back to late October, and NVIDIA broke out of that 211 level, but then it reversed quickly down to the 20-day, and then bounced off that 20-day and made new highs right at that 237 level, and retreated back to this, value area where you had this previous high at 211, and then traded down to that level, undertook the 20-day, and bounced back up and traded towards the 237 level, but never got there. Okay, it never got there. It tested the upper Bollinger Band and traded to 232, and has recently reversed, gone through the 20-day, and is now tested the lower Bollinger Band below that 211 level. And I'm using this 211 level as an arbitrary level. It doesn't hold any key technical merit. It's just it was a key pivot point from the previous high, and it seems like it's more of a gravity point right now. The stock likes to go to that level right now. Something about the 11 handle for these gravity points. It likes the 11 handle. So this 211 level seems to be a gravity point right now for NVIDIA. And it bounced off that lower Bollinger Band and is now moving up towards that 211 level. And it's about $2 away from it as I talk right now. But I really want the stock to go back up and take out these previous swing highs, both on the 232 level and the 237 level. But it may have some more back and forth type of consolidation period, specifically around this, what is turning out to be some type of gravity point on the 211 level for NVIDIA. And we can see here on the weekly chart, the slow line is trending higher, which is very bullish for the long term. But for the short term, we've got this, slow line now going negative. So I think it's good that the slow line is now going negative, because it means that it's getting very close to the point where it can turn and go back up. Okay, and as all this is happening, the stock tested the lower Bollinger Band, and we can see a buy divergence forming. As this swing low here, when the stock tested this lower Bollinger Band right around that 205 level, you have a higher low in the fast line, and that is a buy divergence. And when you look at these oscillators, specifically the 310 oscillator, buy divergences have much more merit than sell divergences. Usually if you get a divergence to the upside, as like a sell divergence, it means that the stock can sell off, but it's not necessarily going to crash. It's just going to go into a back and forth consolidation type of mode. But for stocks, when you get a buy divergence, like you're seeing here, that is usually a good sign that you can get a big upthrust to the upside in a stock like Nvidia. And what we need is this slow line to finish its cycle basically and turn up and go back positive. Now, all that said, it may go a little further negative before it turns up, but the fact that it's holding this lower Bollinger Band and it has a buy divergence, that's all a very good sign. And on the weekly chart, you know, you have this uptrend in the slow line, and the fast line, which is the slow line on the daily chart, is now looking like it's ready to complete its down cycle and turn up. So, with all that said, we look at the fundamentals on Nvidia. So we looked at these earlier. Everything looks very positive to me. You see these earnings growth as those earnings go higher and higher. You see the sales go higher and higher. You go to quarterly, you see that big up moving earnings on the EPS on the quarterly numbers and on the sales numbers. Everything looks fantastic. You know, earnings growth is fantastic. Next 5 years, it's 45% earnings growth. That's awesome. With a multiple that's only you know, 16.8. You know, the stock has a PEG of 0.37. That's all great. So I would everything looks good for the long term in Nvidia, but we got to see it hold this Bollinger Band for you know, for the short term, which is right at 205 right now. Let's see what else is going on. We have the SpaceX IPO coming up on Friday. In my opinion, the stock that, you know, is the best play right now for the whole SpaceX thing is Rocket Labs. The fundamentals on Rocket Labs are not the best, but it's got a lot of momentum. It's got a lot of volatility. A lot of people like to trade it, so, you know, it's worth checking out. The stock kind of held above its lower Bollinger Band. It's bouncing off. You see how the slow line continues to come down on the daily chart, and I think it needs to come down more towards the zero line. It needs to go negative before it turns back up. So I think for Rocket Labs, let the stock kind of bounce around here for a little bit and let that slow line get down towards zero. Let it complete its cycle before the stock, before you look to buy the stock before it trades up towards its 20-day moving average. But it's something to keep on your watch list. The stock definitely has to hold the lower Bollinger Band, in my opinion. But it looks nice. I like it. Looks good. Let's see what else do I want to take a look at. Broadcom had earnings and the stock dropped, but now it's bouncing back off of testing its lower Bollinger Band. And as you see here, the slow line on the daily chart kind of came down, tested the zero line. It's kind of bouncing. That's good. So the stock, you know, had a big sell-off. The slow line, you know, may have completed its cycle, and now the fast line is oversold. The slow line completed its cycle to the downside, and you know, we could easily see some type of buy divergence form here, and you know, the stock could bounce, and you see you can get a buy point right at the 417 level before it trades to 20-day. So Broadcom looks interesting. I like that stock. Let's see here. Astera Labs. This stock I have not figured out how to make money on. I bought it right about here, stock sold off. I bought it here, stock sold off. Stock is now, I got rid of the stock and now the stock is ripped up higher. You know, there's some names that just always have your number. I think Astera Labs is one of those names. But I am very bullish on the stock fundamentally for the long term, and the stock has had a nice run higher. The fast line is coming down towards the zero level as the stock has a consolidation period. The slow line on the weekly chart trending higher, but the fast line is really, really high on the weekly chart, which means that it's due to sell off. Okay, it's due to have some type of pullback, and the fast line is really pulling back. It could probably, with the fast line on the weekly chart so extended, it means that we could get more of a pullback in Astera Labs. It makes a lot of sense for this stock to kind of just, you know, especially with the slow line kind of tilting over like the way it is, it makes sense for the stock to kind of continue to go sideways and kind of form some type of extended bull flag and test this 20-day. And once it hits this 20-day moving average, which will probably be right around 310 or something like that, because you can imagine this going up and then you can imagine this coming down. You know, they kind of meet in the middle right around 310. The fast line comes down to, you know, negative 25 or so, and the slow line kind of flattens out before it turns back up. That would be a good point to buy this stock when it tests that 20-day. But keep it on your watch list if you want to buy it. Another stock that's interesting, Vertiv. I own this stock. Stock's tested its lower Bollinger Band, and the slow line came to negative, so it's ready to turn back up. I love that. I like the stock right here. I think it's a buy right here. You got a nice little divergence. I love that on the fast line, and the slow line's ready to turn back up. I love it. The slow line on the weekly is trending up, but it kind of it's kind of come down a little bit, so that's not a good sign. It's not necessarily super bearish because it can always turn back up, but it's indicative that the move that we've had over the past couple months from here to here is coming to an end, and the stock may be going through a longer term basing. So be careful for Vertiv because it may be going into a consolidation basing period right now. Let's see here. Let's see what else we got. But for a trade, I think at least Vertiv is due to as a buy here right around 320, and look for the stock to go up to 378. But when it gets up to that point, because the slow line in the oscillator on the weekly chart is turning down, you may not get a breakout to the upside. Remember, the bigger time frames are always dominant. Okay, if you're watching the market, you're only watching a 5-minute chart or a 10-minute chart, you're very myopic. I know that may sound harsh, but you're very myopic. You can trade a 5-minute chart or a 10-minute chart, but look on the bigger, higher time frames to help dictate your roadmap of how you go about. Okay. So even though you have a bullish divergence and you have this slow line ready to snap back to the upside on the daily chart, on the weekly chart, the stock has had a huge move and it's due to base. And the oscillators, the way the fast line on the weekly is down like this, the way the slow line is turning down like this, the way the rate of change is now negative, they're telling you that it's made its move. It's time to take a break, which, you know, makes sense. Stocks need to have a rest. You know, they're like people. They get tired. So, another interesting stock. Now, this is one of those can't kiss all the babies. stocks for me. Is that I love this stock. I'm very bullish on it. It's just that I have other stocks instead of it. So you can't kiss all the babies. That's the old term. Yeah, you want stocks, but you can't always have them all. And the stock is going into that consolidation period, I think, right here. As you can see, the slow line's turning down, the fast line's coming down. It needs to get negative, and the slow line needs to come down, but it's formed a nice little pullback here, right below the 20-day, bouncing off the lower Bollinger Band. So it's set up for a move to the upper Bollinger Band, but I don't know if it's set up to break out for another run higher. Because of the way the higher time frames are showing the stock has made such a big move to the upside. So I think it's good for a trade to the upper Bollinger Band as a good target, but I don't know if making another run to 2200 over the next month or two is in the cards. It may be a while before it makes another run higher. The stock may need to go up and then back down and up and then back down before it makes its next run up. A stock that I have is Corning. This stock is bouncing off this lower. It tested the lower Bollinger Band, but didn't test it, and it's right at that 20-day. I love it here. I think it's a buy. Slow line kind of turned down into the negative. First it formed a divergence, and then it came down, and the stock kind of went back and forth. This is a perfect example of like a divergence, a sell divergence that doesn't show a big sell-off. Okay, it basically is indicative of a consolidation period, which is basically, you know, the divergence in a stock chart is forecasting a change in action, not necessarily direction. It's still in an uptrend. It's still, you know, right at its 20-day. It's above its lower Bollinger Band. Everything looks fine. It's just consolidating. But these divergences forecasted that happening, and now we're looking for a move up to new highs. But this may have to, the slow line may have to come down a little bit before that happens. And again, a turn down in the you know, weekly chart on the slow line and the weekly oscillator. So you know, you look at all these charts, and they're all kind of saying the same thing, that even though the market is up today, we may not be out of the woods yet. And my trader friend texted me, goes, this seems like a, you know, just a market reaction. It may not be the main move. It may just be a reaction to what we had on Friday. I think he's got a fantastic point. I don't know if he's right. None of us know if he's right, but I think he has. You know, I had lunch with this guy on Saturday, so I got to hear his you know, we just sit down, we have pizza, and we just, you know, just talk, whatever comes to mind. And so I got a sense of what he feels about the market right now. Much more better sense. You know, I don't care how, but you know, texting will never replace human-to-human contact. You know, just being with him, hearing what he has to say about the market. And I saw my dad a week ago or 2 weeks ago. I got his sense on the market. You know, they're both aligned. And also with me, the line with me is that this market is just so extended. So a consolidation, a back and forth type of market makes a lot of sense here, you know, and I think it's very healthy to see. And we go back. There's one stock that sticks out to me, a stock that I do not own, that is my favorite fundamental stock on the board that pops out to me. When I do my scans and I go through all my stocks, the stock that sticks out to me that I do not own from a fundamental basis is Marvell. And they are making the TPUs for Google, and they have huge growth. It's accelerating, and as I am talking, I am reminded of something that I wanted to take a look at on Marvell. And we'll look at the fundamentals very soon. I got to look at another chart here. I got to look at another screen here. Hold on one sec. So I wanted to look at the margins of Marvell. And like I said, this stock stuck out to me from a fundamental point of view, not necessarily a technical point of view, just a fundamental point of view, from stocks I do not own. And let me see here. I got to do something. I'm just thinking out loud. I wanted to look at the stock's margins. Huh, interesting. I'm glad I did that. And what I'm finding is that the margins on this stock are all over the place. 17%, 91%, 9%, 9%, 11%. Interesting. And so they're not steady, they're not consistent. So let's take a look at the fundamentals on this stock, why I like it. So you see the stock chart, the stock just a huge move. But we look at the forward PE, it's 48 times. And so on it, just the multiple of the stock itself, it's reasonably high, 48. But the earnings growth rate's huge. 42% this year, 51% next year, 46% over the next 5 years. Sales growth rate is 21%, but its earnings growth rate quarter over quarter are negative at 81%. That may be a mistake. But you can see this huge earnings growth on an annual basis from negative to positive. So there may be some issues with that. Gross margin, 50% gross margin. Operating margin, 16%. Profit margin, 28%. That's fantastic. And look at this. So I don't necessarily like this. I know a lot of people do like it, but yeah, there's no red here. There was red. Okay, see, there was. Going back to October, November, there was a lot of individual analysts that were bearish on the stock. Well, now they're all bullish, so the stock's made its big move. So this is a perfect example of how when you have find good fundamentals and you have lots of bearish analysts, that's bullish, okay? Because back then, if you bought Marvell, November, December, when these analysts were bearish or not super bullish, they all have to upgrade, and when they upgrade, that means that fund managers buy the stock, and that pushes the stock higher. Once they have upgraded, it's kind of like priced into the stock. So doing this analysis on camera, yes, I'm bullish. Yes, I like it. But I don't like how you don't have a lot of analysts that need to upgrade. They've gone from being bearish to being bullish. Not a lot of people talk about this. Only Chris Camillo discusses stuff like this. Bank of America Securities was bearish here, right? Well, guess what? Now they're bullish, okay? Let's see. Barclays, now they're bullish, okay? TD Cowen, okay. They still need to move bullish. The fact that they're still bearish is okay. So they need to upgrade their price target. They need to upgrade to being bullish. So you still have someone that can go to the bullish side on Marvell. And they do have fundamental, fantastic fundamentals. And I'm in the camp where, as an individual investor, I don't mind buying a stock that's already bid up, as long as the story is still intact. A lot of people won't buy a stock because it's just moved so much. That's not me. I'll buy a stock that's moved super, gone super high to the upside, especially if the stock has a pullback. So going back to the market as a whole, okay, we're going to go back and we're going to take a look at the market as a whole, and I'm going to look at the S&P 500 futures. We're having this pullback. We're having an updated day, but we've had this pullback. I think as the day has gone on, I'm kind of in the camp of my friend's right, and this just may be a reaction to what happened yesterday on Friday. But we'll see. I don't know anything. We kind of just got to let this market play out. I think that it's good that the market's taking a break, and specifically individual stocks taking a break. We need it. I don't like a market that just shoots up to the sky and then has a crash and comes down. It's not good. So I have been yapping for a long time, close to 2 hours. Wow. I guess that's it for today, and I will talk to you guys all later. You all take care. I'm much more pleased with this stream than on Friday. So, guys, all take care and happy trading. Read that Market Wizards book. That's how you get to the next level. Trust me. Adios, everyone.